So good afternoon. I'm speaking to you from my study in southwest London. And indeed, it seems to me that I've not left my study in southwest London for about 3 months. You know, like everybody, occasionally I used to work from home, but now, you know, as the saying goes, I appear to live at work. Now, happily, I love my job, but even so, I sincerely hope that we are getting towards the end of all of this. Can I also say sincerely that I am sorry that Finsbury's annual general meeting has to be like this year, that it has to be virtual. Meeting with shareholders, meeting shareholders face to face normally is an absolute highlight of any year for me. But you know, here we are, and you know, there you are. In these introductory comments, I am going to say a bit about 2020, how Finsbury fared during 2020, and then I'm also going to just make a few tentative comments about the new calendar year that we've embarked upon. So, you know, I have to say, if you had asked me on the 1st of January 2020, if you'd asked me, Nick, would you be happy if Finsbury's net asset value total return was going to outperform its benchmark? The FT All Share Index is the benchmark, is going to outperform its benchmark by nearly 8% over calendar 2020, would you be happy? Because actually, that's what the NAV did do over 2020. And, you know, of course, I would have, you know, taken that like a shot. You know, in particular, 2020 was, for me and for Linsell Train, it was a significant year. 2020 was the 20th full year of our responsibility, my responsibility for the investment affairs of the company. And of course, to mark a milestone like that, 20 full years with a year of outperformance, sure, that's gratifying, or I would have thought it would have been gratifying. And by the way, I'm going to thank shareholders. I'm going to thank shareholders for the continuing privilege, 20 years and counting, the continuing privilege of taking care of their savings in this company. I might observe my own savings as well in this company. I continued to add to my holding in Finsbury during 2020. I've even bought some more Finsbury in early February. However, notwithstanding all of that, I have to say to you, in all candor, I cannot look back on 2020 with much affection, either personally or as a professional. And I think 3 reasons for me feeling somewhat disenchanted with 2020. I mean, first of all, you know, forget relative performance. The truth is, I contrived to lose money for you in 2020. The NAV total return was down a couple of percent. And, you know, whenever we have a calendar 12-month period where we've lost value, I'm always grumpy. Next, I don't know how it was for you, but I thought 2020 was quite a challenging year. And certainly it was a challenging year for some of the companies that Finsbury's portfolio is invested in. And these are companies in some cases that we've successfully owned for many years, but 2020 was unprecedentedly tough. So just to pick three big positions, but strategically significant holdings. Burberry was the biggest single detractor from our return in 2020. Diageo had a difficult year. Heineken had a difficult year. All of those three were down by the end of the year, well into double digits in terms of negative share price return. And that was a shame and kind of begs the question, what to do? Well, in such circumstances, I quite often seek the opinion of my dear wife. And I have to say, having canvassed Mrs. Train's views, Liz says to me, "Oh, Nick, don't panic. Don't get het up. Everybody is just as desperate to get back into a pub or to travel again as you are. Just wait, they will bounce, it'll be fine." Well, we've taken Mrs. Train's advice and added to all of those three holdings at what I sincerely trust will be advantageous prices. I have to admit, though, we're still in a bit of a waiting game. I said three reasons for some disgruntlement. Just the last one. 2020, it was another year of more or less dismal returns from the UK equity market. And as you probably know, the UK equity market, that's my stamping ground. That's where my career has been based. By the way, June of 2021 will be my 40th anniversary in this industry. And I'm really not sure that I can recall any time when the UK market, the UK stock market, has been as out of favor as it seems to be right now. I'm not going to make any predictions about when sentiment may turn. I'm tempted to, but I won't. All I would like to reiterate, though, is for certain there are some outstanding companies quoted on the London Stock Exchange, and many of those outstanding businesses look undervalued to us. So 2021, or whatever it is, 6 weeks into 2021, I'm in the circumstances, I'm going to keep my comments simple. All I want to do, because I think it's the most meaningful thing I can share with you, all I want to do is note dividends. And actually what I mean particularly is I want to note recent dividend announcements by portfolio constituents, Finsbury portfolio constituents. So in late January of 2021, of course, Diageo reported its 6-month results, its interim results, and Diageo nudged up its interim dividend by 2%. Now, 2%. I mean, you're right. No one is going to, pop a cork off a bottle of Johnny Walker for a 2% dividend increase. But I have to say that dividend increase came sooner than we expected. And when you look at what's going on underneath the surface of Diageo's profit numbers, when you look at this very strong secular increase in consumers drinking premium spirits at home around the world, well, we certainly allowed ourselves to feel encouraged by both that secular trend and that dividend increase. Very recently, RELX, another important holding in Finsbury, RELX has announced a 3% increase in its final dividend. And again, I'm not putting up the bunting for a 3% dividend increase. I'm sure you are not putting up the bunting. Nonetheless, RELX is a business that has been adversely hit by COVID, and its ability, nonetheless, to increase its dividend by 3%, we think sends a strong signal about the, well, in our opinion, formidable business at the heart of RELX, which has a big growth opportunity. I mean, to us, I have to say, when I said earlier, the UK has some truly exceptional companies that are undervalued, listed in London. RELX is the one that's right at the top of my mind. Hargreaves Lansdown reported interim results at the start of February. Hargreaves Lansdown's interim dividend was up 6%. In the same week, Unilever reported its 12-month numbers. It so happens that those numbers weren't well received by investors, so it goes. But we noted that Unilever's fourth quarter dividend was put up by 8% over the same dividend 12 months previously. And Unilever commented that a reason to put the dividend up 8% was their awareness that there is a strong recovery underway in their sales in India and China. During 2020, a great deal of Cadbury's chocolate and Oreo's biscuits were munched by consumers, looking for some sort of comfort treat. That's allowed the owner of Cadbury's chocolate and Oreo's biscuit, Mondelez, which is an important holding as well within Finsbury, that's allowed Mondelez to increase its final dividend by over 10%. I've just got one more, and I acknowledge actually this dividend I'm just about to highlight was declared back in 2020, okay? But the single biggest investment that we have in Finsbury's portfolio, which is the London Stock Exchange, the most recent dividend announcement from the London Stock Exchange was an increase of 16%. And what has happened for the London Stock Exchange in 2021 is they've been able to announce the closure of their deal to acquire Refinitiv. That is a strategically significant deal for the LSE that at a minimum, in our opinion, at a bare minimum, is going to allow that company to continue increasing its dividend for the foreseeable future as well. So listen, I'm sure you get my point. Strong companies can carry on keeping on. Just those businesses I've mentioned in that previous spiel, they represent over 50% of Finsbury's portfolio by value. We'll find out what the other 40-odd% do with their own dividend announcements over the next 2 to 3 months, I guess. But, here we have a collection of strong equities increasing their dividends by at least the rate of inflation, and in some cases well above the rate of inflation, offering starting dividend yields also well in excess of the rate of inflation. That is a great basis for acceptable equity returns. And yes, I hope those dividend increases are a portent for better absolute returns from Finsbury's NAV as we get deeper into 2021. So I'm simply going to say, stay well. Spring is near. The sun is shining. Let's hope the pubs do open soon. That will help our booze stocks. And also from my own point of view, I just, let's hope that the UK stock market does provide something of a happier hunting ground over the next few years. With that, thank you for listening to me. I'm now happy to take any questions about any subject that you care to ask me.
Right, so the first question I have is from Guy McNaughton. Hello, Guy. He says, would it be advantageous for the trust manager to have greater scope to invest outside the universe of UK companies? Guy, I think this is probably one for both the board and the manager, but speaking for the board, you will be well aware that one of the main reasons we were very keen to persuade Nick to take on this management back in 20 years ago was his already established renown in the UK corporate sector. That's where we thought we should be. That's where the majority of our shareholders obviously like us being. So if it's down to us, we would be pretty reluctant to change that because it would have fairly major implications as to our classification. You will recall we did make a little flex last year to make sure that companies whose main business was in the UK, Manchester United, for instance, would be regarded as within the UK mandate, regardless of where their actual listing took place. But Nick, I think you wanted to add a few words of your own on this.
Well, yeah, Chairman, thank you and the board for reconfirming that view. And yeah, I am a great believer in sticking to your last and sticking to your area of competence. And yeah, I've no doubt that my area of competence, such as it is the UK equity market, and I think shareholders will get the best of me if we continue to focus there. I think the only other observation I might make, I've already referred to it in those opening comments, but I do feel that any temptation put in the way of a manager currently to reduce their exposure to the UK equity market at this juncture, any temptation it is imprudent and unhelpful. I think strategically reducing exposure to the UK stock market after this prolonged period of disenchantment would be a value destroying thing to do. So I prefer to maintain the status quo.
Tom Allen has asked two questions. I'll take them sequentially. First one is, many companies struggle when influential CEOs depart. So he's wondering if Nick thinks there has been a hangover from Paul Polman's retirement at Unilever.
Well, yeah, interesting. I mean, let me just acknowledge, Paul Polman did an excellent job at Unilever, 10 or 11 years, however long that tenure was. I'm going to say, because I think it's important to understand the prospects for Unilever. What Paul Polman did was to execute a pivot in the shape of Unilever's portfolio to significantly increase its exposure to personal care and beauty products. That's now the largest single revenue stream within Unilever. Dove has become the biggest single brand in Unilever over the last 10 or 12 years. And I'd put the success of that very much down to his strategic perspective. Second, the reaffirmation made under Polman of Unilever's commitment to growing in growing economies, emerging markets. That is a significant strategic commitment, marked by the company increasing its stake in its Indian subsidiary over the period, Hindustan Lever. And again, we've no doubt that India is going to be a major driver of growth for Unilever in decades to come, frankly. The other thing, and maybe it is the most important of all, definitely Paul Polman was in the van of increasing the credentials of Unilever in terms of its sustainability, in terms of its environmental and ESG credentials. And that's ever more important for the sustainability of companies and the sustainability of investment cases. So a good job. And by the way, I just looked at this. When Polman was appointed, Unilever's share price was roughly £15. It was in 2009. It's just under £40 today. So actually, I mean, that's a very, very steady return, and considerably better, by the way, than the UK stock market in general over the same period. So good job done. I'm not sure that we can see actually a hangover post Polman. His successor, Alan Jope, he was the chap who drove the growth in personal care products. I think it's very interesting, by the way, to note that the fellow that Alan Jope replaced as head of that division, the biggest division of Unilever, came from Amazon. That was Jope's appointment of an ex-Amazon executive. I think that's indicative of the sort of ambitions Unilever have for that division. So I can't say we see that Alan Jope has changed the strategy, or even necessarily, to use a cliche, put a foot wrong. No question, though, I don't know about a hangover. COVID, it has been a challenge for Unilever. I think the performance last year as a business, and indeed as a share price, it was quite resilient. But if you've got 60% of your business in emerging markets, which Unilever does have 60%, 2020 was always going to be a challenging year for the company. I think we're looking for better years ahead for that emerging market exposure. It's essentially the reason that we have the investment. I think that's what I would say on that question.
Tom has a second question also relating to Unilever, which is as follows. It seems the very well-respected COO of Unilever has implemented some changes to the organizational structure. So he's wondering why this is the case and what is the issue they may be trying to solve.
Since we're not face to face, I can't confirm this, but I'm going to assume that you're referring to the change in domicile and the unification of Unilever's share structure that was concluded in 2020. Forgive me if I've misapprehended that. And what I would say was, on the second time round, for that simplification of the constitution of the company, as it were, we were supportive. We do think it makes sense for Unilever to have one single piece of equity. And we do think that that's right, because it increases the flexibility that the company has to both make disposals, actually, but more pertinently, maybe to make acquisitions. We don't know what their plans are in those regards, but yeah, that increased flexibility it's bestowed on the company, to use sort of financial market terminology, that's increased the optionality, the strategic optionality the company has, and there's probably some value to that. So that's our take on that.
Arthur Collins, I hope I'm pronouncing that right, Arthur. Arthur asks, some time back, Nick was reported as saying that he was having difficulty in finding suitable candidates for inclusion in the portfolio. Has the situation changed?
Yeah, I would say that the situation has quite definitively changed. In 2020, we added 2 new holdings, got very close actually to adding a 3rd new holding. That didn't quite work out. We'd added a new holding in 2019 as well, and one in 2018. That might not sound a lot to you, but actually from our point of view, that's hyperactivity. There was a long period in the, say, between 2010 and 2016, 2017, where we didn't add a new holding at all. So there's been a definite uptick in actionable, from our point of view, actionable new ideas for this portfolio. And I mustn't keep harping on about this, but I think the reason is because, let's say, more or less arbitrarily, since that Brexit vote in 2016, since then, the UK has been drifting, and the UK stock market, and to a significant degree has been friendless. And that has created, in our opinion, increasing opportunities to take advantage of what we see as material strategic mispricings of companies that just happen to be listed on London. To us, there's many companies that we analyze that we're sure, if they weren't listed on London, but anywhere else in the world, would have a higher valuation today, and quite possibly a significantly higher share price. So we've wanted to respond to that, emerging or developing opportunity. I will just say, that's true of the existing portfolio as well. There were times in 2020 when, we thought there were some really, once in a decade opportunity to add to existing positions within the portfolio, and we were able to take advantage of that. So I'm just as happy, and I think everybody should be just as happy to add to an existing business that you have a high regard for as to necessarily start a new holding.
Next one from Stephen Chen goes as follows. Mr. Train has mentioned in the newsletter that he expected Hargreaves Lansdown to grow at a double-digit rate for many years to come. I wonder if he can share, in general, how the team builds estimates with regard to long-term sustainable growth rates for those predictable businesses the fund invests in or plans to invest in.
Was I really that specific? It's most unlike me to make rash, precise forecast such as that. I will just say, in passing on Hargreaves, that business looked as though it had a pretty robust 2020, as evidenced by that set of interim results that we've relatively recently seen. Customers and assets under management at Hargreaves have doubled since 2015, and it's hard to see why that growth opportunity has diminished. It's very, very far from being a mature business in our judgment. I'm conscious, Chairman, of the time here, and I could embark on a lengthy account of how we model and think about security value. I might just say, though, growth is important when we think about businesses, but it's not as important as impregnability of a business franchise and sustainability of a business franchise. Where we spend the bulk of our analytical work is seeking to understand why a company's brands or franchise has been successful and survived for long periods of time, and why we expect or hope that it will continue to survive and thrive into the future. So for us, growth is nice to have, but the important thing is the resilience of a business. And, you know, if I might allow myself to say, when I look back at the performance of Finsbury during 2020, which was an extremely challenging year for companies, you know, I'm pretty proud of the resilience that the business models we've chosen, the resilience that they showed.
Next question from Peter Lineker, who I hope is still on the line. Peter asks, we have seen and appreciated the stellar performance of the LSE group within the portfolio. If one were to extract that performance, what would the performance of the trust then look like? That's a tough one. Less good is the answer, I think.
I mean, that is the two-word answer.
Yeah.
You know, we've owned this since 2004. I mean, I think in terms of a sort of archaeological challenge that Peter's set there, it would be almost impossible to disaggregate over such a long period of time, you know, what that investment has contributed at the margin. But yes, it's been a big driver of the long-term outperformance of this company, which I am proud of. And it's been a major contributor to returns over the last couple of years. The LSE has performed as a share price and a business in the way that we hoped it would, which it's offered some proxy to the bull market for technology and data and analytics companies, because that's what the LSE is turning itself into. With the acquisition I mentioned earlier of Refinitiv, that technology, data, analytics part of the company gets even more significant. I think, Peter, the real nub of the question you've asked is, do we think that the LSE could continue to offer as attractive returns over the next 15 years as it has over the last? Yeah, I am going to stick my neck out and say, yeah, we wouldn't willingly sell a share of this company at this juncture. We think its trajectory is still very strong.
Next, I have, I think it's actually a composite question from Muzamel Shah. I hope I'm pronouncing that right, Muzamel. It reads as follows. What are your thoughts on the current market? For example, the new retail traders coming in and pumping up lots of stocks like GameStop and AMC. Also, the amount of SPACs coming into the market and companies with zero revenue going public with insane valuations. On the other side, there's more insane valuations on SaaS stocks like Snowflake and Cloudflare, and also the EV stocks like Tesla, who have a market capitalization of almost 800 billion now with only around 200 million profit. Do you think this is similar to the dot-com bubble?
You know, I'm going to be shiftily evasive here. Michael Insel and I sort of made a pact many years ago that we would never allow ourselves to express views about the market in these sort of terms, or even, you know, we try not to have views about the market, just because we demonstrated to ourselves before you were born, possibly, who knows, that we have no particular value to add from market timing. So I wouldn't venture an answer specifically to that question. I might say briefly, number one, private individuals increasing involvement in capital markets, that's a good thing in our view. It's good for individuals, it's good for economies, it's good for capitalism, for people to be more involved in investing. We have investments in companies, some of which we've already alluded to, that are beneficiaries of such a trend. Second thing I would say, I don't know. where we are in a boom or bust cycle. What I do know is there will be a roaring 20s to look forward to. That roaring 20s is not going to be the result simply of a rebound from COVID, although there will be. The roaring 20s are going to derive from this extraordinary creation of wealth and productivity enhancements that this current technology wave is delivering. And that makes me optimistic for economies. It makes me optimistic for the companies that we're invested in. The last thing, I know that you know this, but let me just reiterate, the way I might capture those comments is to say Finsbury is and has always been fully invested, 100% invested, but with low, virtually negligible borrowing. So roughly 1% borrowing. So we are 100% exposed to equities and the good things that I hope can be delivered by equities, but without the sort of leverage or borrowings that might make the returns excessively volatile. I hope that mix is going to generate satisfactory returns for us all.
Question from Edward Robinson. In the latest fact sheet, you commented Experian Q3 revenues were up 7%, with the company guiding to a strong full-year result. Its shares are down in January because of the Democrat clean sweep of the US elections, raises the possibility of regulatory intervention for the credit agencies. Please, could you explain what implications these regulatory interventions might have for Experian?
No. No,
that's quick.
Sorry, but I could only attempt what I would personally regard as an unsatisfactory response to that question, and let me tell you why. We have spoken to both Experian and Equifax, which is the US listed other major credit bureau competitor to Experian. We've spoken to both companies about exactly this issue. And understandably, neither of the companies can give a definitive view today or last week or when we spoke to them, because there are no concrete or definitive proposals. It's more of an aspiration that the Democratic Party expressed last year. Both companies, Experian and Equifax, say they agree with the objectives of the Democratic Party, which is to increase access to credit across the US economy. Definitely, there are parts of the US population that are unfairly excluded from the credit markets, particularly minorities. And both Equifax, Experian, and now the Democratic politicians who are ruling the United States currently want to remedy that. And I'm always an optimist. My hope is that they find a way to work with the Democrats in a way that will increase the provision of credit and increase the value of those franchises.
The final one of our pre-AGM questions comes from Harshad Katecha. Have you changed your strategy to include smaller companies like Fevertree in the portfolio that does not have a very long history compared to the majority of the companies you hold? If so, why?
I really don't think that the strategy has changed. I don't think that initiating the holding in Fevertree signals a change in the strategy. If it does, it's completely unintentional. Listen, the success of Finsbury, I don't know what the future brings, but the historic success has been based on taking strategic holdings in companies that own beloved or trusted brands or that have impregnable franchises. Sometimes they're big companies, Diageo, Unilever. Sometimes they are much smaller companies. We initiated a holding in PZ Cussons about 18 months ago, the Carex brand. that's a fantastic, trusted brand, but that's only a £1 billion company. That's a relatively small business. So we're size agnostic. It's the caliber of the franchise or the brand that we're looking for. And Fever Tree might not have the same heritage as a Burberry or a Johnny Walker, but to us, there's no question that what's been created in Fever Tree, essentially a new category of premium mixers, that is, it's an exceptionally valuable consumer brand, and we want to own more of it.
Next one's quite an interesting one. To what extent does extremely high short-term valuation lead you to consider selling or reducing a holding? I think that's a good one, Nick.
Well, we are the effect that we have captured to date, and I sincerely hope we can continue to capture into the future. The effect that we're seeking to capture is running winners. And if that is your chosen approach, then you have to acknowledge that there will be periods when a security that you own may get somewhat overvalued, may go through a period of underperformance as a result. But to us, it's worth living through such episodes in order to capture the full effects of the long-term compounding. So it would be less to do with valuation and more to do with a conception that a company that had reached the end of its strategic optionality. It would have been very, very easy for us to have sold out of the LSE at a number of points over the last decade. Obviously, I pick a big winner. And the LSE probably is trading on 30 times earnings roughly today. That's not ostensibly cheap, but strategically, that is not a business that has reached maturity in any way, in our opinion. And our tendency would be to hold winning companies.
Next one is from Sean. Given the latent value of the portfolio and the exciting future ahead, could you not have eased our pain a little this year and increased the final dividend a little? I note your massive revenue reserves. Well, I don't think it's fair to tax you with that one, Nick, because it's a board decision. Sean, we wrestled with this one, as you might well imagine. I don't, in all honesty, think our revenue reserves are massive. They're of the order of a year's dividend or two at the most. But we felt we couldn't, in all honesty, justify an increased dividend against the appalling year that was coming up. But equally, we didn't want to signal too much nervousness. And so the decision was to maintain it. It'll be a decision for the board going forward. I won't be a member of it next year, but we do try to balance expectation against availability. And that was the answer we thought we should come up with last year. So I think that's the best I can give you on this one. George Black asks, do you consider the predicted reduction in GDP arising from Brexit is currently priced in share prices? And if not, when do you think that might occur?
I think it's, I can't prove it to you, but I think it's not only discounted, I think it's excessively discounted in sterling asset prices. I think global investors have been worrying about this for 4 years. Hedge funds have been feasting on shorting sterling assets for 4 years. I think the pessimism is excessive, and as I've tried to convey, I think that creates opportunities. Again, it's so important not to make the category error of conflating the UK stock market with the UK economy. It's a very global stock market, and there are some outstanding global businesses in the UK valued lower than comparable businesses elsewhere, and that's an opportunity I sincerely hope.
Alex Richardson asks, wouldn't you rather some of the high return businesses invest more of their retained earnings in value creative growth rather than raise their dividends? Yes.
I think that that is a learning for businesses and institutions in the UK over the last 5 years in particular. I think one of the issues for the UK, one of the structural issues for the UK, is that companies have been encouraged to distribute too much of their earnings, particularly companies that have got a structural growth opportunity. I think that the sight of the wealth being created on the other side of the Atlantic from companies who are much more reluctant to distribute earnings at too early in a stage, that's an important learning for everybody. So I expect UK companies' behaviour to change somewhat, and there to be a greater focus on growth value creation.
An anonymous question, Nick, what about your continued support for Pearson? Is this still justified?
You know, you're one type of investor or you're not, and we are patient. Sometimes we are patient to a fault. That which has allowed us to benefit from the LSE's ascent is exactly what has kept us, you know, invested in Pearson. You will know as well as I do that Pearson's share price actually went up during 2020, and in the process, therefore, materially doing better than the UK stock market. And so far in 2021, Pearson's shares are up another 10 or 11%. Of course, I hope that is a sign that investors are recognizing that there is a potential for a return on the very significant investment Pearson's made over the last 7 to 10 years in digitizing its products and services. We'll see what the new chief executive has to say early next month. But on an 18-month view, you know, I'm happy that we hold it.
Again, it's anonymous. How do you assess the value of brands that have established positions but struggle to grow? AG Bar might fit this description.
You know, it is an important question, and let's acknowledge all brands, all businesses go through periods where, you know, growth is harder to come by. The important thing in a business is the cash flow return on capital, and what we're looking for in companies that are maybe growing more slowly is that they're able to maintain high cash returns on their business, because that cash generated can either be used to reignite growth in existing brands, it can be used to diversify, possibly into contiguous areas, or, you know, in the final analysis can be used to retire stock, retire equity to increase value per share in that way. And so certainly as far as AG Bar is concerned, all of those options are available to that company. Not least AG Bar is one of the many companies that we have in Finsbury that's got net cash and no debt on its balance sheet. So that's a business that's got a lot of strategic optionality currently, and we'll be fascinated to see what decisions the board makes as it emerges from the lockdowns.
One last question. This one caught my eye, from Rahul. Many investors in Finsbury Growth Trust are experienced. As a relatively new investor with a 25+ year horizon, what is your reflection on investment strategy of FGT over medium term of 5 years?
My reflection is that when we see transactions taking place for businesses of all types, when you see deals being done, the premium, the uplift that's paid to get 100% control, 100% ownership of the cash flows of an outstanding brand or of an outstanding franchise, the value is often very, very materially higher than the stock market value. And in our experience, very materially higher than the valuations, I see on the companies that we're currently invested in. And that reinforces for me the validity of what we're attempting to do. Let's hope we can get it right for you. The validity of owning rare or exceptional assets and franchises. I look at every business we own, and to me, it's got something unique about it that other companies can't replicate. And I don't know when, in some cases, I don't know how, but I've got to believe that if we give it time, then the value, the latent value we see, to reuse that term, will eventuate.